all know we're screwed. The question is, what if it's going to get worse? What do we do?
I'm not doing anything differently because I've been preparing for this crisis for a long time. In fact, a lot of people were making fun of me because I've been preparing for so long because they think that what I'm preparing for is never going to happen. Well, it's going to happen. It hasn't really started yet, but we're getting close. You know, the problem is the Fed's been operating its monetary policy while looking in the rearview mirror because they keep creating inflation, right? Printing money, quantitative easing, whatever you want to call it, and they keep printing more and more money. And they look in the rearview mirror and they look at the CPI, and as long as it's below 2% or some version of it is below 2%, they think it's okay to keep printing money. Meanwhile, they're ignoring the road ahead. They keep looking in the rearview mirror at these CPI numbers. And they kept, printing money and inflating asset bubbles and distorting the economy and leading to these debt bubbles and letting the government get bigger and bigger and bigger, spending more and more borrowed money. And then all of a sudden they look in the windshield and they're staring at these big CPI increases, and their initial reaction is, oh, don't worry about it. It's nothing. And then after a few more months, well, it's transitory. It'll go away. And now they've got this huge problem, which has been inevitable for a decade. In fact, back in 2009, when the Fed first made the mistake of going down this road of quantitative easing and 0% interest rates, I predicted exactly the predicament that they're now going into, because they have this massive inflation problem. They can't do anything about it. They're talking about tightening up on policy, but what they're talking about doing is going from very loose policy to slightly less loose policy. They're not talking about tight money, which is what they would actually need to put out this inflation fire. But by tightening up a little bit, they're going to prick the bubbles, or they've already pricked the bubble, and you're seeing all these risk assets imploding right now in price. The economy is already rolling over into recession just because the Fed is supplying less monetary heroin than they were. But the fact that they're still supplying some means that the inflation problem is going to keep getting worse. So this is the Fed's worst nightmare. It's stagflation. And the question is, what are they going to do? Are they going to keep tightening up policy and push the economy into another financial crisis, not just a recession? Or are they going to reverse course, go back, reverse any rate hikes, expand quantitative easing, and just make the inflation problem much worse? 2022 is going to be even worse than 2021 because a lot of companies held back on price increases because they thought it was all transitory. Well, now that they realize that's not the case, you have a lot of companies that are rushing to make up for lost ground, and they're announcing major price hikes here in January. They're probably going to do more later in the year. Look at the price of oil. It's already exploding. It's up about 20% in the last few weeks. We're at a new high for the year. We're at $85 a barrel. I think we're headed over 100 this year, maybe closer to 150. I think by next year we'll be above 150 in the price of oil. It's not just oil. It's all sorts of energy, but it's agriculture. It's industrial materials. The government is trying to blame it on a supply shortage. It's not a shortage of supply. It's a surplus of money. It's all the money printing that is creating the problem. Had the Fed done the right thing after COVID and contracted money supply, then we wouldn't see these big price increases. Maybe there would have been a reduction in supply, but there would have been an offsetting reduction in demand. Instead, we reduced supply because everybody was staying at home instead of working, but we increased demand because we gave all the people who were staying at home more money to spend than what they used to earn when they actually went to work. So it was the worst of all policy mistakes. We threw gasoline on the inflation fire, and now we're dealing with the consequences, and it's just getting started. The problem is they're going to raise rates enough to crush the economy, but not enough to slow inflation. And in fact, as inflation gets worse, that's going to be another drag on the economy. And so what you've got to do, what I'm trying to tell you, is you've got to get out of all of the bubble assets that were propped up by all the cheap money. Because even though money is cheap, it may be slightly less cheap for a while, and that's enough to collapse the bubble. But you can't just go to cash because inflation is very high and it's eroding away the value of your cash. There's no safety there. You can't buy bonds. Bonds are even worse than cash because it's cash in the future, but in the meanwhile, you're tying your cash up and inflation is eating it up. So people have to go out of these risky momentum stocks into value. And what we're seeing is a massive shift out of U.S. growth stocks to international value stocks, stocks in Europe, stocks in Asia, basic businesses that have real earnings right now, that pay good dividends right now. That's where investors are hiding out. That's why you're seeing some of these stocks up 10, 20% on the year with no news, even as U.S. tech stocks are cratering and all the bubble stocks, including the cryptocurrencies. All that stuff is going down. You got to get into real assets. You got to get into value. You got to get out of paper, and you got to get out of U.S. paper in particular, because we've got the biggest inflation problem that we can't do anything about because we're so loaded up with debt. There's no way to fight inflation without collapsing the entire economy, because the whole economy is built on the foundation of these artificially low interest rates. But in order to fight inflation, you have to remove that foundation. And then if you do that, everything built on top of it comes crashing down. People who get hurt the most are the people who are retired. You know, when you hear the news reports, they always want to focus on wages and whether wages are keeping pace with inflation, which they're clearly not. But at least if you've got wages and they're going up 5% and prices are going up 10%, well, you're only 5% poorer. But if you're retired and you've got a fixed income and, you know, and prices go up 10%, you get stuck with the whole 10%. And, you know, a lot of these retirees have been forced out on the risk curve. They've got all these overpriced stocks that pay no dividends, and those stocks are crashing right now, and their whole retirement is going up in smoke. I mean, nothing's safe anymore thanks to the central bankers. So you have to look at degrees of risk. And to me, I think it's a lot less risky to be in foreign equities than U.S. bonds. I think it's a lot less risky to be in gold and silver than in U.S. dollars.
So is one of your strategies in stocks, because you said you talked about dividends, are you always looking for stocks that pay a dividend? Is that one of your primary strategies?
Yeah, I mean, that's one of the ways you know the stock is a good value. You look at the income, just like when you look at a piece of property and you're looking for the cash flow, you're looking at what the rents are relative to cost of operating it. If I own a business, I want to know what my piece of the profits are. What am I going to get? What's my return on my investment? Forget about potential appreciation. I don't care about that. I mean, what if I never sell the stock? What is my return on owning this stock? And that return is the dividend, right? Now, it can also be capital appreciation if the company has enough income to buy back stock and deliver some of my income in the form of capital gains. So you also look at the earnings, because most companies don't pay out all their earnings in dividends. So you still are, you know, entitled to a share of the earnings of the company when you're a stockholder, even if those earnings aren't paid out in dividends. But you look at all these valuations and you determine if that's a good place for your money. Now, fortunately, there's a lot of good businesses around the world that we can own a piece of and preserve our wealth that way. But, you know, all of these assets are going to get increasingly more expensive for Americans as the dollar loses value. So people have to act quickly while they can still afford to buy these stocks.